Good morning, everyone. It's June 26, 2025, 8:28 a.m. Japan time. Today, I'd like to review the market and touch on some recent US economic indicators, especially electricity consumption, which has come into focus lately. Let's start with the Nikkei Inigo. Yesterday, it closed at 38,942, showing continued strength. It's up 0.39% yesterday, and the volatility index dropped again to 23.29. What's really worth noting is that the PER is at 50.52, and the EPS has recovered to 2509 yen, which we haven't seen in a while. The momentum behind earnings is clearly strong. Despite elevated interest rates, this consistent EPS recovery seems to be providing solid support for the market and could even be contributing to a short squeeze. Based on current simulation, I estimated that unrealized losses on cash market shorts are probably in the 500 to 600 billion yen range, and the maybe tipping the scale toward the strong side. However, even though the Nikkei was strong, there were more declines than as advanced as yesterday, suggesting selective market. That said, overall, the index itself remains resilient. The CFD is currently around 3,898 84, a slight dip from yesterday's high of about 39100, but it still reflects a strong phase. And the USD JPY is at 145, indicating a renewed dollar buying as yen selling trend. That's to maybe boosting the equity market in Japan. In short, we are seeing two key supports: the currency tailwind from a weaker yen and earning momentum via stronger EPS. Turning to the US market, the S&P closed around 6092, almost flat, but the VIX fell to 16.76, indicating a very calm environment. Long-term U.S. interest rates are also declining. The 13-year bond yield is now at 4.83%, suggesting a stable backdrop. We're also seeing early signs that S&P may finally be shaking off the funding stress shock, Trump shock from late last year, and gradually entering a new bull phase. As for gold, it's been rising steady. Early we saw panic buying driven by fear and the Trump tariffs, but now the rally looks more structural, possibly linked to gold's role in the AI-driven economic shift. It's less about panic, more about the long-term positioning. Currency markets continue to reflect yen weakness, and the global equity markets also seems to be stabilizing. Despite the geopolitical tension, we are clearly in markets supported by fundamentals, at least based on current indicators. Let's discuss Bitcoin and the electricity demand. Since Bitcoin is tightly linked to power consumption, it's relevant here. From what we are seeing, electricity consumption in the US remains solid. That reinforces the Bitcoin value proposition, especially if energy shock risk in the Middle East don't materialize. Electricity is essentially the lifeblood of AI. So if energy prices stay under the control, it supports both the digital economy and Bitcoin. Electricity price in the US are still stable around 30.1 to 30.3 cents per kilowatt hour. That's be slight inflation, but nothing alarming. And don't forget, the IRA is still providing subsidies, which helps keep price in check. In contrast, Japan's electricity price has been rising, partly due to geopolitical risk, Iran-Israel tension, and the seasonal factors in June. But the U.S. still appears to be in stable zone, at least based on the March-April data. We'll need to watch the May-June figure closely. As for the March power consumption numbers, they were strong. April monetary supply M2 also showed no sign of contraction. So overall, we are not seeing any liquidity stress yet, and the energy foundation for AI growth seems to be stable. In short, we are looking at a strong macro backdrop where AI-driven demand meets energy stability. As long as the FRB does not aggressively hike rates and M2 stays relatively unaffected, and there's a room for continued growth. Of course, geopolitical risk could change things, but as of now, things are calm. If it stays this way, equity could remain strong. So, in strange way, Trump's recent action might be help to stabilize things, at least for now. To wrap up, geopolitical risk will continue to cast a shadow over this divided global economy. But based on real indicators, this market remains solid. That's it for today's episode. If you found this helpful, feel free to link with my contents by following me, and I'll see you tomorrow.